Welcome to the Dividend Talk podcast, episode 88, European Dividend Earnings. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to talk about the earnings of some companies like Danone, Wolters, Kluwer, BASF, and many more. See you on the inside. Hey, European DJ. Earnings is still going. This must be what, our third or fourth week, and it's still going strong.
Yes, definitely. It's amazing, right? And I like this season a lot because it's not like all at once what you typically have with quarterly earnings season. Some companies are really quick with providing the results, others a little bit slower. It seems to go a little bit slower in Germany with everything because it is BASF this week for Fresenius, both the medical care and the normal one, Henkel, MunichRe, and quite some German stocks today. So, and I like some of these really a lot. So I'm really, really curious about them.
Yeah, it's going to be lots of German stocks, as you said. They are quite slow at releasing, but that's always good because when you get too many companies at once, obviously they slip through the net. So at least to give us some time to look at them. Some of them I have in my portfolio, some of
Mhm.
them I would like to have in my portfolio. So I'm interested to hear on the ones that I didn't get around to looking at. But before we get into all that, we talk about some news. And I don't think there's any surprise in what we're going to talk about. I mean, we try to keep politics out of this a whole lot, but we seen how the market has reacted this week alone to what's going on in Ukraine. It's very volatile. The market's volatile, and obviously what's going on is horrendous. It's
Yeah,
absolutely horrendous.
yeah, yeah. So from a let's first talk about it from stock market point of view. It
Mm.
is crazy what happened today that the prices shot up all around the globe, right? 4 or 5%.
Um,
So I put a tweet out and that's a little bit how I felt like isn't it sad that the market priced it already in if you believe in efficient market theory? It's kind of okay, we know now it's an invasion there. Will not really hit our portfolios from that point of view. It's isolated, so yeah, let's move on. Next. Yeah. What's next week will be interest rates again.
yeah, I didn't get it. So there was obviously the market was starting to drop when the
Mhm.
attack happened, and all that really happened after that was parts of Europe and America came out. They didn't really do anything other than say that they're sanctioning 50% of
Yeah.
the banks, and I mean the sanctions weren't as harsh as I thought they were going to be, and all of a sudden the stocks started rebounding. I'm like, oh my, like what is going on here? It makes absolutely no
It's
sense.
crazy, right?
Yeah,
Yeah, because when Crimea was being occupied or captured, let's say, there was really like a strong market reaction then, right?
yeah.
And those times, and now it's like within a week, it's like, oh, fuck it, give us the interest rates again.
Within a day, within 2 days,
Yeah,
I
yeah,
mean, it makes no sense. But the markets have been irrational, I feel, for
yeah,
since COVID, really, since
yeah,
COVID. I mean, we had that huge reaction after COVID where prices just
yeah.
soared to all-time highs, and
Liquidity
it
from governments, everything. Yeah,
it seems like the markets are disconnected from what's happening in reality.
yeah.
But eventually, they might catch up. I don't know, but it's
Well, they
crazy.
will, right? As soon as there's an economic impact, and the
Mm.
question is, of course, will it have an economic impact? I mean, I'm not an economist to be able to judge that. I don't understand the sanctions here either, so I can't really judge. But yeah, very interesting. I'm glad that I've got a dividend portfolio of these kind of boring companies. Last year, I did like somewhere in the summer, like check my top 10 on financial stability and such. So I know that
Mm.
AFI is the weak part in my portfolio from a balance sheet point of view. So, makes me really sleep well at night with my portfolio. I'm really not worried here.
I tell you what I done. I haven't said this to you off air. I remember I had that put in Alibaba, which I was
Yeah,
obviously down on. I've sold that at a loss. So
yeah,
I mean, I knew this was coming. Earnings was coming. The sentiment in China was not
yeah.
great anyway. I expected this market not to I didn't expect it to rebound anyway, but I was there. The risk is just too great because it's a cash secure put, so the cash was there for it. But you know
Yeah.
that if it drops, premium rises, and the margin required actually might be more
Yeah.
than what the stock would own, and I would have to fund that,
Yeah.
and it could happen so quickly. I was like, you know what, it's not worth the risk. The markets might tank. I'm happy with my portfolio. I will sleep well with my portfolio. The only one I would not sleep well with in such a severe
The
reaction
options.
is
Yeah.
Alibaba. With that one, so I sold it. I took a loss of about $1,000.
Yeah.
But to me, when I spoke to my wife about it, I was there and I was thinking about it for 2 days. I said, I don't think about anything else in my portfolio. For me, that's a sign. Get
Yeah.
out. I
Gotta
need
get
to get
out.
out, and now I can sleep well. And
And I know that you made like many more thousands of dollars last year on option trading.
yeah, I
So
mean, I made 4,500. I made what 1,500 this year. So I think I'm still
yeah.
net up this year. Maybe
Yeah.
not as much, but I mean, to sleep well at night,
Yeah.
it just seems so much
I
better for
made
me.
$200 on option trading this year so far. So you're really way more invested with option trading than I am making here.
Yeah, well, I got Baba wrong. I thought it was going to rebound
Yeah.
quicker. I would be happy to hold them in well, let's say normal market, but if they were to decline at a steady pace, it's more manageable because the premium is not going to jump massively.
Yeah.
But when it gets more volatile and you have huge swings in premium,
Yeah. You need to
then
get out. You need to
then
get out of these options. Then.
if the margin required is more than the 12,000 I need to buy the 100 shares,
Yeah.
then I just can't afford. And then there's opportunity cost there because I have that 12,000 locked up, or if it was 15, 16,000, whatever I own.
Yeah.
I can't buy anything if anything drops.
Yeah. Yeah. Exactly.
So
I think if people expect volatility now, I would say like, and you can't sleep well, close these options. And I hope there's not too much loss, right? I've got one option on Intel for $40, and I just keep it. It's in June. If I get for 40, I'm happy. Yeah.
I
So it's not too much money behind it either.
yeah, I have the same. I have Intel for $40 and I have Unilever at $42, I think.
Yeah.
But I'm really happy to close them. And even with if they were to go large swings, the volatility, the money I would need to front up is not as
Yeah,
huge.
you could easily cover it.
And I can easily cover it, yeah, and I can sleep well easily with them. So I'm happy with those two, but I'm straight out of Alibaba.
Good. Well, Alibaba is my worst performer so far since last year. So it's testing my valuation skills, let's say.
What I have done, what I did do then is I set a buy order at $50, $50 for Alibaba if it gets there.
Wow, that would be great.
Well,
Yeah,
not for you, but if it got there, it would be good for me.
No, why not? I would probably buy some then because for $50, give me Baba. Also, now I find it attractive. If I wouldn't have had a full position,
Yeah,
I would have been buying now. Yeah, so
yeah. I think with everything that's going on, the European markets, Russian markets, it's just so hard to take a like for me, they're a gamble. They are
yeah,
a
they
gamble.
are. Yeah.
And that's.
But you know, I that's the 10% of my portfolio where I can play a little bit with that, right? So, I mean, it's all for me. I've got it all curtailed. Let's say it cannot affect my portfolio because it's not being hedged or something like that. If the company goes bankrupt, I will lose 4% or 3% of my portfolio. So be it. Yeah.
Yeah.
I'm not worried about it at all.
But I think it's good for listeners to know because options is always out there. And I think the misconception is that it's easy money. It's not. First of all, it's not easy money, and there is a lot of risk involved in it. And I'm very transparent. I will tell you when I fuck up or when I make a mistake or when because I'm no expert on it. But just be careful, especially when it gets volatile. Just make sure you're covered.
True.
You're good to go. But we'll move on to some earnings. We have quite a few companies, a lot of German companies, but I think we might start with
the French.
With little Frenchy, yeah. Little French.
Yeah, you're talking about fuck ups, right? Everyone knows, I think, that follows me that Danone was my buying spree in 2020.
Yeah.
I discovered the company really. I'm not discovered, but from a dividend growth point of view, I studied a lot, and then it cut the dividend last year. I think from 210 to 194.
Yeah.
So this year they kept the dividend flat again, 194. New CEO is in. I must confess that when I was reading the press release and the related earnings there, I started actually to like what I'm seeing. He also appointed three new people in early of January. I don't know if everyone noticed that, but they're now, what is it? New. I don't have the roles here, but they hired like a chief innovation officer, a new chief operations officer, and I think a chief sustainability or something like that. I checked those profiles and they look solid. The CEO, I forgot the name where it comes from, but when I tracked his performance, he came from a really high performing company. He did a really great job there. So I'm slightly optimistic from the first kind of sound bites that I'm getting through. Also, the fourth quarter earnings were much better in a comparison to a year before than the first three quarters. I won't say that this is all to do with the CEO. Definitely not. They have a little bit of, how I said, higher restructuring charges at the moment as well, because they are going to from a corporate central French kind of way of managing towards local, right? They give power
Yeah.
to the regions,
Yeah.
which is interesting to hear that from a French company, right? It's like so un-French. But having said that, generally their dividend is really well covered, right? They have an what is it, an EPS of 294, so it's easily covered. The dividend is safe. The dividend was even safe at 210. I still don't understand why they cut it. But what I was always thinking about, like, this should recover after COVID because the restaurants are closed. And we know that Wolters is also a large part of their
Yeah.
sales, and Wolters started to recover, right? What was it? 25% year-over-year growth since last year. Now, it's not the biggest big business unit. That's still the dairy, right? The dairy products and such.
Yeah.
But and that was a bit a slower grower, but it comes also from a higher margin. That's from a higher baseline. But yeah, the first signs are there for recovery, I would say, in Danone, and that's, I think, also why we saw that the share price started to recover this week a little bit and respond positive to the news. And for me, it's so clear that it is kind of COVID, but also, of course, the company was not well managed, right? And
Yeah.
that's why it was not really able to do anything good during COVID. It got it straight in the face.
I mean, I think what is being played out in Danone is exactly what we kind of said. We knew where it was throughout the pandemic. It was struggling. Waters was obviously down. That has a huge increase, like double digits, 17% increase or something. That is predicted. So it was quite obvious they're going to have low growth and Waters was going to come back to normal. I believe, I must double check. I believe they're nearly back at 2020, 2019 levels, which is good.
Yeah.
Good for us. The question is now, where do they go from here? And as you said, the new CEO has come in. I think his name is Antoine.
Yes. Yeah.
Yeah,
A
Antoine
different,
Saint
yeah,
Afrique
difficult
or
name.
something
Yeah.
like that.
Yeah.
So, what's he going to do now? He's already starting to make changes, restructuring.
Yeah.
They have their European restructure model completed now,
Yeah.
so it's time for them now to kick on and grow. We've campaigned and championed this company a lot in this podcast, particularly in the early days.
Yeah.
So it would be nice for us if they start to deliver on their
Well,
promises.
they have a capital market day on the 8th of March. So I'm definitely having that in my calendar because I
Yeah,
think this is where we will hear his new plans. And this is the first time I will really be seeing the new CEO in action from that point of view. Yeah. And then he's out in the open, and yeah, then we will hear whether there are any plans that excite us, right? I really believe in this company like Danone. Also, if I see how it's taking shelf space in the supermarkets around me, the vegan milk and everything, it's really really getting more and more shelf space. I see it everywhere popping up. So and this is in Poland, right? So I expect this business to continue to do well. It grew 8% year over year, EDP. So those are good numbers, And these vegan milks, they cost like 3 times more, 2.5 times more than normal milk. So
Yeah.
yeah, curious to see what he says on the 8th of March. Look, simply said, we know now that the floor is there in the dividend, 194. It comes from a really small cut because of this idiot of a former CEO. You get it now for 3.46% yield, almost 3.5% yield.
Hmm.
If you believe in a European company, you need to take into consideration the French withholding tax, which you need to reclaim here. Yeah, not bad. I mean, the price didn't go anywhere in the last year, so it's not like you missed out on something if you still initiate a position now, right?
Yeah,
It
and
is not that it has uncertainty around it, right? Because it didn't prove itself over the last year.
yeah, and who knows? We have to wait and see what happens at this investor day or this capital day that they're
Yeah,
going to have, because they might come out with a lower guidance than expected. Anything can happen.
yeah,
They might shut back
exactly.
down. So
Yeah,
it'll be interesting to see. We'll keep an eye on that one.
yeah.
And the next company is one of these boring Dutch information paper companies. I think that you're a big fan of.
Yeah, this is
Wolters
Wolters
Kluwer.
Kluwer. I mean, I remember it still from my student time. I was studying in yeah, how do you call it, applied sciences, and I had a student job where we were supplying the data also to Wolters Kluwer. Effectively, Wolters Kluwer gave us dirty data, and we put it all in XML and cleaned it up and submitted it back. Right, that was kind of the job. So they outsourced that to students.
Nice.
And so I know a little bit what kind of data it is here, but revenues 6% up, 4.7 billion. I mean, for a boring company, we're talking about top line sales here, right? It's not too bad, 6%. Operating profit up 11%, so 1.2 billion. Earnings 3.38. To be fair, diluted adjusted EPS 3.38, 17% up in constant currency. Yeah, there's a catch there because of the tax rate. They had some tax benefits here this year. So, and also in their guidance, they expect this to be a little bit not so positive next year, right? So and this is what I like. They're honest about it. They're not like celebrating and not mentioning it, and then next year everything is wrong because of a tax rate or something like that.
Yeah.
But hey, dividend hike, 15%. These motherfuckers. I mean, I love Wolters Kluwer. It's still a bit too expensive for me at $88. They expect a mid-single digit growth next year. They are buying back shares again, so I'll probably keep staring at this one and missing out on it. But hey, you get it now for a 1.77% yield and 31 years of consecutive dividend growth. It's an amazing company. It's on fire. Their business and the digital business, print is going down, but it's expected because who still wants paper copies, right?
Yeah.
But
Yeah.
the company is just doing exactly what it needs to do. It's so well executed. I mean, yeah, really great company.
Yeah. Nice.
Good
Nice.
earnings.
Still a little bit overvalued. Like you said, it's a low starting yield, which is 1.7% starting yield, I think, around
Yeah.
that. So look, it still has a bit to go. But for the print company, it's a company you would think they'll never make money, or
Yeah.
that they just had an incredible record. So
Yeah, but I think if you're a lawyer, you can't ignore the Wolters Kluwer databases. It's kind of your toolbox, right?
yeah,
So
you need to have them.
yeah,
Okay, we might move on to one of our German companies. Might move on to Henkel first. And Henkel is a one we have never really covered before, but I believe a few people have started asking around them. They've dropped in share price. The share price has been in such a steep downward trend that
for 5 years, I believe, right?
5 years, yeah. So now all of a sudden the value, I'm not so sure, but they are a big brand. They're a big brand throughout Europe, and they have brands such as Persil, I think, for wash machines, and they use adhesives. Fun fact: when I worked for a mobile phone company, I was their account manager, so I know how much they spend on mobile phones in Ireland, which was quite large actually for such a small company. Um, Not a small company, but small in Ireland. But let's just have a look at their earnings. So their sales was up to 20.1 billion, which is up 7.8% organic growth, which is quite good. Operating profit increased 4.2, EBIT margin was 13.4, and earnings per share was up 9.2. And they generated 1.5 billion euros in free cash flow. They call it good free cash flow. I don't have the definition of what they call good free cash flow, but that's just what they call it. The dividend per share is 185 for preferred share, and the outlook for 2022 is mid to what is it, unchanged from last year. So I think it's like low digit growth. Um, but look, for me, they are probably look a solid company. Their financials don't look too bad to me initially. I haven't dug deep into their financials. This is just all really top level. They have really good brands. They have good brand power. I'm not quite sure why they've been down in a downward trend for 5 years. So there must be something underlying there that I haven't
Yeah.
that I haven't heard of.
Yeah, what I didn't like about these earnings results is that they want to do a buyback now for 1 billion. You know, they keep the dividend flat, and then I think, like,
Yeah,
why are you going to do a buyback for 1 billion? Just give us a dividend hike and let me decide what to do with the money. Yeah,
yeah,
this is what I find annoying with buybacks when you have these kinds of companies that are not well run. Then I rather make my own decision as an investor. Of course, when they are really undervalued, I get it, yeah, and it's also more tax efficient.
mm.
But undervalued and poor performing, then I start doubting, if you know what I mean.
But the question is, are they undervalued? I don't know if they're undervalued.
I don't know either. For
Yeah.
me, they don't. Let's say like that. I don't have a good enough feeling with it.
Mm.
But from the first look, when I looked into it also a while ago, when people started asking, I don't have a feeling necessary that they are undervalued. I rather have a feeling that they are trading where they belong to trade.
Yeah. And to me, that looks the case. I mean, there's obviously a reason why they're in a downtrend for 5 years. They have such good brand power that you think
Or
that
not.
maybe not, but some I recognize some of them brands instantly,
Yeah.
and
Yeah. Yeah.
so they do have really strong brand power. So
Yeah.
there's obviously something there, and it might be good to do a little deep dive on these and see why, because they seem to be quite
Yeah.
popular. But look, I'm not opposed to the buyback, particularly with the share price dropping. But as you said, is the management good enough to do it? Probably not.
Yeah. Yeah. I think some of our German listeners will be able to say much more about Henkel. So if you have any further feedback, let us know on Facebook in the Dividend Talk group. More than happy to listen to it. And by the way, now that I think about it, if you like this podcast and you want to engage more of us, come to the Facebook group, Dividend Talk. We'll put the link in the show notes so that you can just click it there and get there. Having like 450 group members at the moment, so not too small anymore.
Growing, yeah, growing fast. So that was Henkel. The next German company we may look at is Fresenius, maybe. I think you looked
Fresenius,
into, yeah.
yeah. I looked into Fresenius, and you gotta love these headlines. By the way, I bought some Fresenius not too long ago, right? I initiated a position after I analyzed the company. It gave me a good enough feeling, thinking like, yeah, this company is safe, dividends will be safe. So I'll initiate a position. I kind of like also the business that they are in. But then their headline, and this is what already gives me an allergy. Fresenius delivers a strong finish to the year, meeting its improved 2021 guidance. Strategic evaluation shows path to accelerated growth. And then when I go into the numbers, right, it's I don't see it. I really don't see it. I see a growth of 3% over the whole year. Of course, in the last quarter they had a growth of 7%. Then I see an EBIT which is down 8%, and then the net income 4%. I don't find these good numbers for a company that of high quality. Specifically, if you think about what they have behind them, and they're still saying like COVID-19 impact.
Mhm.
And yes, I can see that, right? And it was really tough earlier on this year as well. But I don't agree with the narrative of that these are good numbers. These are like blah. I don't know really what else to say with it.
So you notice that they say, right, strategic evaluation shows path to accelerated growth. And if you look at their investor relations slide deck, the presentation, and you scroll down to page 8, and you should see then a graph, and it'll give you 2021, 2022, 2023, and they've given this in the previous years, and it shows you that they were expecting it to be flat and growing gradually, and then in 2023 it's magically going to take off again. That's the way they're perceiving it, and I think that's where this headline is going, saying that the foundation for that is bigger than expected. It might not be brilliant, but I think that they're ahead of where they expected to be at this point. Now, if you're to look at that graph, it's saying that they expect sales to grow at a 7% CAGR, and they're really going to accelerate in 2023. I don't know if they
Well, I
will.
think they have some really nice catalyst here, right? In general, they are impacted really a lot by COVID. That's also why I initiated a position, right? I also am very, very curious about their vaccine business that they are considering and the manufacturing around that. Or biosimilars, sorry. I mean, biosimilars business. I think there might be some potential there. Not sure yet, because I think they're doing this with a Spanish manufacturer. Not sure how well they are in execution. But I found this a nice position for my portfolio, right? But then just when I look at such a report, I don't just like the headline combined to what I see in the numbers, right? I like more like these straight shooters as CEOs. So that's the only thing I have with this. But other than that, look, dividend increase again. What was it 0.90? 92 cents. 2.86% yield. 29 years of dividend growth. I mean, for me, the dividend is really, really safe with this company.
20% payout ratio. I mean, it couldn't be safer. I think it's a 15% CAGR on that as well. So to me, and I got the feeling going through that slide deck that I don't think they were trying to be misleading here. I think they are genuinely trying to gear towards 2023 and accelerating their growth then. But obviously, when you see a headline and it's like big and flashy like that, mean, okay, come on, rein it in a little bit. It's not spectacular.
Exactly.
It's not spectacular, and it should probably mention there, okay, we are ahead of where we want to be in our 2023 target.
Oh, and then it's a total different
thing. If they say that in the headline, you're happy. But that's the sense I get going through the slide deck. That's what they're pushing for. So.
Yeah, well, investors thought a little bit different, right? Because they put the price. What is it? 12% lower. Yeah, in 2 days. So that's their reward of the numbers. So, yeah.
Okay. What about MunichRe? It's a company that we've covered on these insurance companies. They've had a good year. Insurance companies, as I think you predicted, would have a strong year. They generated 2.9 billion in 2021. Consolidated profit expected to rise to 3.3 in 2022, which is quite good. So they're still expecting next year to be better again. They've initiated a new share buyback scheme.
Come on, jump to the dividend, please. Come on, jump to the dividend. Stop the crap.
I'm getting there. The dividend was increased to 11 euro per share. 11
there
euro
you go. There you go. This was a great hike for such a boring company, right?
I mean, they had a really good year, and they do tend to reward their shareholders. And what's interesting is that they say, like, okay, we're expecting this to jump again next year, which we know what will happen. The dividend is going to
52 years of dividend growth, 52 years without a dividend cut. That's MunichRe.
Yeah.
I believe I know it almost from my heart. It wasn't 1974 or something like that, or 1970. 1970, yeah,
1970.
1970.
Yeah,
No
1970.
dividend cut since 1970. MunichRe. I bought it at 145. I should have loaded up the truck. We always know that in hindsight, of course. I mean, this is your example boring company. Screw fintech. Fintech. I don't want fintech even near this. Let it please compound. Don't touch it. Um, I mean, what is from 9 euro 60 to 11, right? I don't know. I don't know the numbers. I'm just doing this from my head, knowing the dividends from the last year. So these are amazing hikes. Maybe 990. What was the last dividend?
I think it was. Yeah, I think it was around 980, 990. It was.
Yeah. Well, look at that. Look at that. I mean, what's not to love in such a company?
I mean, the problem I always have, they always seem overvalued, and we say this a lot about these type of companies. They always seem overvalued, and they just keep
Yeah, but
delivering.
this is a company where I would say like here you just get it. What is it? 4.5% yield?
No, don't think it's that high at the moment. I think it's
No.
4%, 4% at current.
Okay. Where do you get a 4% yield with a company that has been growing for 50 years their dividend, or 52 years, plus I said a safe dividend that is highly expected to grow going forward. I mean, honestly, for this, it's not richly overvalued from that point of view. It doesn't have such high multiples. So for me, I would treat this more like a bond.
Yep.
Yeah, if you want to buy this stock for the next 10 years, this is how I look at MunichRe. Yeah, for 10 years, it goes from 4% maybe to 7 or 8% annual yield on cost. That's what I'm expecting here.
I think they're actually at the same price of when we analyzed these. I think these were one of the first companies we did,
Mhm.
and they were around $250, €250 at that stage as well.
Yeah.
So it's interesting. But no, good dividend hike, good numbers. Next year they're expecting good numbers again. So
Yeah.
why not? Why not get involved?
Hey, looking then quickly at another insurance company, ASR from the Netherlands. I covered it recently a bit in my 15 dividends, Dutch dividend stocks post. And this company is kind of like a fast grower in the last few years. And well, shall we also just go straight away? I mean, this dividend talk, right?
Yes.
19% increase in dividends, 19%. Another insurance company, these boring insurance policies, 19% increase. Proposed dividend for 2021 is €2.42, coming off a base of €2.04. I mean, yeah, okay, you want to know something about the results? Operating results increased by 15% over 21. I mean, you know what? I'm not going to read it all for the listeners. Just good results. I would, we always advise people to do their own homework. You get this company now also with 9 years of dividend growth and a 5-year compounded annual growth rate in dividends of more than 15%. And you will get it now at a 6% yield.
Wow.
Yeah, that is something, right? A company hiking a dividend from, let's say, from 5% dividend to, with 19%, right? It is quite a thing.
Yeah, that's
So
quite big. Like for such a high starting yield, you're getting super dividend growth as
yeah,
well. You don't get many high yield, high growth companies.
yeah, yeah, yeah. So and this is the only catch here is that these companies, and this is what happened also in 2020, right? They had to postpone the dividends and then group the same because then the central banks come in Europe and say like, insurance companies, we would like you to preserve your cash at the moment, right? It has preference. But quite quickly after that, they still paid it. So if you're really in need for stable cash flow in uncertain times, you need to be aware of the risk here, like banks, also with these Dutch insurance companies.
Yeah, very good. Who did we miss? We missed BASF, I think. We missed.
Yes, I mean, I don't know what, it's clear that this season is really great, right, for European stocks as well. BASF, top line growth compared to 2020, when it was hit with COVID-19, of course, 33% sales growth, right? And this is really huge, really, really huge. Also, what was it? Net income 5.5 billion. Last year they made a loss. I believe they had quite some write-offs last year as well. So they had last year. You need to see it like kind of a kitchen sink report that they did. They just took the opportunity that the news was anyway already bad. Let's make it totally bad. Now we have the opportunity. I said their free cash flow was 3.7 billion here, and just good results. What you need to know, I believe, that their dividends are not so richly covered. So they increased the dividend from 330 to 340, like a little hike. That's why the dividend is now 5.6% yield at this moment in time. But look, chemicals division up with 68% year over year. Materials up with 41%. Where do you think the inflation is coming from, and where do you think a source of inflation is?
Yeah, I mean, a lot of companies are, I mean, raw materials are really hard to come by in chemicals, and then you have these companies who supply it. So
Yeah, exactly.
they have to
So
pass, they have
so
to pass on the
BASF is
cost.
on the winning side of this when
Mm.
you think about it. So I've got some BASF, right. I bought also last year again. I've got like 2/3 of a position build up. I just like this company a lot. It is really committed to the dividend. It has 12 years of dividend growth. They cut it during the great financial recession, I believe in 2009. They cut it with, top of mind, 10% that year, 10 to 15% year. But other than that, if you take that out, it quickly recovered from that. I believe their dividend growth is since 2000, just so for the last 2 decades. Quite solid, high yield, low growth. That's the typical company here. It is cyclical, so the numbers look a little bit better in good times, like now. So you need to take that into consideration. I think it's trading now around 60 euro. I'm sure that in a down cycle you can get it for 40 euro or something like that. So it depends really on whether you want to take the 5% yield now and already reinvest that in other companies, the dividends, or whether you want to wait for a bottom of a cycle. I decided to buy it now already, like last year around these numbers. I think I bought the last one at 66 euro. It's now trading around 60 euro because at the bottom of the cycle, I don't want to buy BASF. I want to buy Nike. Yeah, I want to buy more Microsoft. So, and I don't want to be lured in then by these kind of companies
Yeah.
at that moment in time.
Okay, very good. Yeah, a 5.46% dividend yield is enticing, and I think maybe for the next 12 to 18 months they're going to benefit. So it's not a bad short-term play either.
Yeah.
And the last company we have is a Spanish company, Iberdrola.
Iberdrola, I think it's
Iberdrola.
called. I don't know. I just wanted to highlight that they hiked their dividend again to 44 cents, which was interesting because when was it? In their guidance 2-3 years ago for this period, they said dividend will be around 40 cents, right? So they're still going a little bit above it. I think it was 42 point something cents last year, so a little hike, but you get the stock now for 4.44%. But look, this one is a lot into clean energy, right? Iberdrola. So if you like clean energy
Yeah.
plays and not oil and gas, then Iberdrola is really something here. It is really investing a lot in renewables, but profit up by net profit up by 8%, EBITDA up by 20%. You will have exposure with this company, not just to Spain and Italy, I believe, but also to America and Brazil. So I find it a really interesting company. I have so far not pulled the trigger yet on this company. It's trading around 10 euro, 9.92.
Yeah.
And something is missing for me to get fully convinced. I like that it's on renewables, but I don't know. Sometimes I have this feeling with Southern Europe companies that I need to be convinced twice as hard. Yeah. So with Enagas, for me, it was a clear case. With Red Electrica at the time was a clear case. I just love really the business. I have the same with Iberdrola, but something is stopping me here. So maybe a listener can push me a little bit to be more convinced here. But the company in general is really nice,
Yeah.
doing well. Stable dividend growth. That's what I remember. you can't rely on the dividends if you look back on it from a 15 to 20-year point of view. You can't rely on dividend growth, really.
Yeah, and that's the nature of the business that they're in. I mean, one thing I do like is that they've got their prices locked in for 2022. I don't know if this war is going to change that, but
Yeah.
when they certainly did this, they had the prices locked in, which is good, gives it some stability. But typically in energy, we know prices can fluctuate. One-off events like wars
Yeah.
will 100% increase that and increase rates on
Yeah.
them. Um, they are doing a lot of investment as well in green energy. Like you said, they have 3,500 megawatt of renewables installed in 2021 alone, and another 7,000, double that again under construction. So that they are really, really going for this green energy. And fair play to them. I mean,
Yeah.
I,
Well, I
I
just hope that they continue paying dividends if there's a year with a little bit less wind.
yeah, but the dividend yield's a little bit low for me for the risk you get in
Yeah,
companies like this.
exactly, exactly. Specifically, that's not a stable payer, in my opinion.
Yeah, yeah. I mean, typically these you want the higher yield because you're taking on that risk, and that's
Yeah.
my problem. Okay, cool. Um, that's all the companies we have, so we might move on to some listener questions.
Yeah, definitely. And the first one's from Phil Sackler, as always, right? And he's asking whether we heard about the SAP's dividend hike and what do we think about the 50 cents extra to celebrate their 50-year anniversary. Well, actually, we looked at just back before the show to dividend history, and they did the same like in 2012, right? They
Yeah,
gave like a 40 cents special dividend. So it's kind of as per expectation, but I like it. It's good that they do it. It's a one-off. I believe that shareholders have not been really rewarded over the last 2 years, specifically not the shareholders that were in it for the share price. If you think about without the special dividend, the company is going to pay 195. It's like in that case it would be like a net 4 or 5% dividend hike. It's not too much, right? So I expect more from SAP. They should grow quicker with the cloud. We saw the numbers before, right? So I like that they do this 50 cent gesture, but in reality, it's a normalized. Let's say it's a 4 to 5% dividend growth, which I would expect more from a cloud business. I would,
yeah.
yeah. That's it. Just
Okay. Kurt has asked us, as dividend lovers, please have a look at Belgian B Post Group. They are transforming into an international logistics player and reinitiating a strong dividend of 49 euro cent.
yeah, I looked into it, and the first thing I do as a dividend growth investor is pick up their dividend payments page, and then I see indeed that they cut the dividend in 2020 and are actually already in 29 over 2019, 2020, and now reinstating dividend. I need to see more evidence. So that's really simple like that. And the business that they are in, it's not a business that I really get excited about, that I want to build my portfolio around for the next 10, 20 years. I think there's a lot of competition there, low margin business.
Yeah, that was my thoughts. A lot of competition, low margin. I suppose the key word that he used there is transforming into an international logistics player. To me, they look mainly Belgium at the moment.
Yeah,
They might be transforming into it, but there's a hell of a lot of competition, and just because they are gesturing or saying they're transforming into this doesn't mean
yeah.
they're actually going to be a major player there. Um,
And it's such a company I would want to check back in 5 years from now. Until
yeah,
then, you can better take UPS. They did a
yeah.
40% dividend hike not too long ago. So
I mean, Kurt has mentioned these are deep value. I'm not so sure. I think they're
no,
probably valued as they should, based on what they've done in
exactly,
the past. So,
exactly.
if you believe they're going to transform into this huge international logistics player and can compete with the big guys, sure, maybe they are deep value. I would not be convinced at this
No,
point.
super.
Um, Catalan dividend investor, what would you do differently if you started all over again? Invest all my money into Shell when it was 10 euro.
I would start earlier, and I know this question is not like that, but I regret that I didn't start in my 20s, that I didn't already saw the light. Let's say I discovered it relatively late. I feel so. I'm really sometimes jealous on those teenagers that already discovered this.
Yeah, when I was in my 20s, my priorities were completely different. Uh,
Yeah, but I
it was
was
more,
storing stuff on a bank account, which was not needed. Yeah,
yeah,
I could have
but
put it in dividend stocks.
my personality was different. I mean, I would have spent every single penny I had on shit
Yeah,
or traveling on, and I wouldn't have cared, and I enjoy myself. If I was to stumble across dividend investing in my 20s and tried it, do you know what? It wouldn't have worked for me, and I may not have come to it later in life because I said I've tried that, it didn't work. So
yeah,
I don't regret anything. What I don't know if I do anything differently because I know how I operate. I like to learn. And I do make
yeah,
mistakes. I need to make mistakes to learn, otherwise I don't. So I
yeah,
need to just throw myself in there. I don't go all in. I go
yeah.
in step by step, learn, and keep going. So
Well, I wish I was more consistent in my investing. What I did is like in 2014, kind of, I started in the autumn of 2014, and you had also the Greek debt crisis then, and all these kinds of
mm,
things lure like still hanging around. And I was all time thinking like, the market is overpriced, it might go down. So I was hoarding cash instead of
yeah,
dollar cost averaging every month. And it took me until 3 years ago that I really saw the light there after analyzing my performance year over year and felt like, why I've not been spending all my salary? Why is my savings account growing? Yeah, and now I still see that from my initial plan in 2014, I'm still like half a year to a year behind when
yeah,
it comes to where my portfolio should have been, just because I didn't invest those euros in those months.
yeah. But then when you're beginning, I mean, you make a plan. Of course, you make a plan, but it's sometimes not easy to follow through because when you make a plan and you're new to something, it may not be correct, or
Yeah, but he's
you have
asking this
doubts.
question assuming to learn from us,
Yeah,
right? So I would say, like with the knowledge I have today, I would have been really, really laser focused on my consistency by deploying and investing the money every month, and not thinking it might go down, and 3 months from now I might have a better opportunity because you see these YouTube videos also now from Sven Carlin. He's doing this. Oh, market crash coming. I was sensitive to that in those days.
yeah, clickbait. But
Yeah,
actually, do you know what? One thing I would do differently. One thing I would do is that when I started, I followed the dividend growth investor, which is fine.
yeah,
And I ended up with some shit companies like Waco, for example.
mm,
If I was starting this again, I would solely focus on companies that I know and understand
yeah,
and work
yeah.
in. I would start with those companies and get a good understanding because I know how these companies operate. I know how they make money. So it's easier to go
To get
through
started.
their
Yeah,
financials to see where that money goes through. So that's probably what I would do. Invest in what you know. Somebody famous once said that before.
yeah, yeah. True. Hey, next question then from Thiago Diaz. The market seems to have swiftly recovered from the Ukrainian conflict intraday dip. Did you manage to catch anything on sale, and whether we have any interest in Russian equities at these price points?
I didn't buy anything on sale. I did not expect it to expect it to rebound so fast. I did sell Alibaba, like I said, but I genuinely thought that I would get at least 3 or 4 days to think
Yeah,
about it. So I didn't rush into anything. And to be honest, I'm so busy in work that by the time I get home in the evenings, the European markets are closed.
yeah,
I don't like rushing something when I'm at work on my phone because I just feel like I'm just
yeah.
doing it for the sake of it. And then I got home too late, so I didn't really do anything. Have I any interest in Russian equities at these price points? I had no interest in Russian equities before, and I have no reason to change my stance on that now.
Yeah. For me, it's the same. Too busy at work. I missed the dip. Fine. And not interested in Russian equities. Also, um, my approach to I can own anything, right? But what's now happening, I don't see a Russian equity as a safe space for my money
No, nowhere near. I mean,
because I want to protect principal first. Yeah. So, and I know it's maybe a bit hypocrite when I'm investing in Baba Chinese stock, but yeah.
Yeah, but the situation is different. You're investing in Alibaba, Chinese stock. I know there's regulations, pressure,
Mm,
but we've got direct sanctions. We got so much risk associated with these Russian stocks. I think it's
yeah,
slightly different. I mean, it is a risk. It could pay off handsomely. I mean, it could make you rich essentially if you get it right, but it could also send you to the poorhouse as well.
exactly. Hey, next question is from The Runner, and his Twitter handle is Raining in My Sea. Really interesting. Anyway, he says, if I sell a put for stock X, so it's about options, strike 50, expiration June 2020, what happens if X reach 50 in April? I mean, in real world, what happens? Is it exercised automatically or the buyer can wait till June before exercising it? I think you can answer this question probably better than me, but it's probably something different between US options and European options, right?
Yeah, I mean, European options, you're pretty much safe until the end of expiration. You don't really have the risk
Mhm.
of early assignment. You do have that risk of early assignment in US stocks, but it doesn't mean it's going to happen. So if it dropped to $50 in April and your expiration date is June, more than likely, it is very unlikely that you're going to be assigned at that point. If it dropped to maybe $30 or $40, then there's a higher chance you're going to get assigned. But certainly, if it's in around the strike price and there's 2 months to go, you're probably safe enough. It depends on who has the option on the other side. I would suggest honestly just buying books or there's a YouTube account, Option Trader, I think's his name, and he has a whole course on this on basics, and I suggest checking that out and just make sure you understand the difference in European and American companies and their stocks. Um, and yeah, not much else to say. It's not guaranteed to be taken away, but there is a chance it could.
Yeah. Super. Then Vladivener asks similar about Russian equities. So we answered that already. And Gabriel Birosh is asking about whether I bought some Dutch stocks based on the article that I wrote about the 15 stocks. So like I just mentioned, Gabriel, no, I was just too busy at work. I had no purchase orders outstanding at the moment. So that's how it goes, right? I'm not all the day watching on my phone or something like that. Work first because otherwise I won't get my savings rate. It's as simple as that.
I set up a pie on trading 212. I put €50 a month into those 15 Dutch stocks, and I
And
have them called European DJI's Dutch stock pie.
and is it open public so others can also take
I
it?
think so. I'll check, but it's
Yeah,
it's it's all those
but
companies are
but
just
it must
stuck
have
to
a
them.
decent yield, right?
Yeah, I think it's like expected return is 14-15%. So I mean,
Yeah,
it's quite decent.
super. Hey, then one of the last questions, or the last question, no, almost the last, is from Paul. He is asking, what about Home Depot valuation after some correction from their all-time highs?
I mean, this has come up quite a bit. I've seen them on Common Stock, which is the social media platform I'm on, and Twitter all day today and yesterday. Actually, so they must be after dropping quite hard. I think you have Home Depot, or you're
No,
looking at
no,
them, do you?
no.
Um, I mean, I don't know. I don't have the company, and I've no intention of getting them, so I don't have.
So for me, it's a high quality company. I've been indeed following it a little bit. We have Leroy Merlin and such kind of,
Mm,
and what is it? The German ones. We have them here in Europe, so it's a bit far away from us, but they have had excellent growth over the last few years, also in the dividends. So that's why it's a really attractive stock. I believe the share price went 20% down. So I guess that makes this attractive when people take a clue from the share price. I think it's a 2.5% yield when I checked it, something like that. Still, I'm doing top of mind, but I would need to study it, Paul, really to give you a solid answer. But I can understand why you're asking based on the price action and the price direction and knowing that's a high quality business.
Yeah, it seems to have had a sharp decline since the start of the year. Just checking. Dividend yield is 2.4, but they are still at a level of from June 2021. So I mean, I don't know. They probably need to come down a little bit more to see if they're undervalued. You see, a lot of it is price, isn't it? It's price action orientated, and as soon as the company drops, I think people are automatically starting to thinking that it is undervalued. I don't think that's always the case.
No, but that's why you can look at price to earnings, and that's why
Yeah.
I like to the price to earnings multiple. I don't use it so much, but I do use it for the litmus test, right? If I see a share dropping 20%, I go to PE 30, and I know that it can be wrong, right?
Yeah.
But for me, that could already be saying like, okay, you know what? I don't even look at it because the yield is also low. Why bother? Yeah.
Yeah.
Okay.
Interesting. B at President 2012 has asked us, is ticker symbol UNM finally on track to be a good buy?
I have no clue. I'm sorry, B.
I
I
don't
have
know.
no clue.
I know they're an insurance company, but that's about it. I don't know. I don't know. Sorry.
Yeah. I know I looked at one time into it, and maybe he asked us about. Then I looked into it, and it wasn't too bad. But again, there are so many stocks in the world, and there's not one that I decided yet to fully analyze. So that's why I can't answer the question.
We need someone like the kind of capitalist on here who's like an encyclopedia of companies. Like he just seems to know every company.
Yeah, but it's for him about a lot of European companies and how you say it, semiconductors, right? Yeah, but yeah, let's challenge him if he knows it.
Last question of the day then is from Average Pilla. If your portfolio could only have 3 stocks, what would you choose?
Microsoft, and Microsoft.
3 shares of Microsoft.
Yeah. How about you?
I would have Microsoft there. I would have ASML at the moment.
Oh, yeah.
One more company on top of that, maybe someone like Louis Vuitton. Let's go with Louis Vuitton.
Yeah, nice ones. Good, thank you. Look, Derek, thanks for the show today. I hope shit will stay out of this world here near us. I was thinking more about that than my portfolio this week, but then if I see the portfolio value just before the show, there's a reason why I can sleep well, because I have invested in high quality dividend stocks with stable modes. So it's good to know that my money is secure from that point of view.
It's good to hear. Good to hear. And all our listeners, thanks for tuning in. Stay safe, particularly all our European friends. And we will see you all next week.